All right, let's jump right into it. Welcome to This Explainer. Today, we're unpacking a really wild financial mystery hiding right behind the absolute biggest name in artificial intelligence right now. I mean, we all use their tools, right? We see the massive headlines, the sky-high valuations. But today, we're pulling back the curtain to look at the cold, hard math. It's something called the AI cost paradox. And we're going to see exactly why OpenAI actually loses money on literally every single chat.
Just look at this single terrifying number, negative 122%. Yep, you heard that right. Despite boasting a massive, multi-billion-dollar valuation that has the whole tech world completely obsessed, OpenAI is currently operating with a staggering negative 122% operating margin. Just let that sink in for a second. In any normal business, a margin like that would trigger absolute panic. It means for every single dollar they bring in, they aren't just failing to make a profit, they are spending vastly more than that dollar just to keep the lights on and the servers humming.
And that brings us to this incredibly stark reality, perfectly captured right here. Every time you ask ChatGPT a question, OpenAI loses money. Think about your own habits for a minute. You log on, you ask it to write an email, maybe summarize an article, or fix some code. The interface is super fast, sleek, and it feels like absolute magic, right? Well, that magic is hiding a brutal reality. They literally lose money on every single chat you start. The cost of the computing power needed to generate your answer is actually way higher than the tiny fraction of revenue they might get from that one interaction.
So this massive contrast between the slick user experience and the chaotic financial backend forces us to ask a pretty serious question. Is the world's biggest AI company truly a revolutionary tech giant laying the groundwork for our future? Or is it just a deeply flawed financial coconut stand from hell? I love that phrase, coconut stand from hell. It's just such a vivid way to describe a business model that seems fundamentally broken right at its core. But to really grasp what that means, we've got to break down the unit economics.
Which brings us to Section 1, the coconut stand analogy, demystifying AI unit economics. Okay, so to understand how a wildly popular product can be so financially upside down, imagine you're running a business. Let's call it a coconut stand. The resources you need to produce your product, your inputs, cost you 2 bananas. But you're turning around and selling that product to your customers for only 1 banana. See the problem? You're taking a loss on every single transaction. It's basically the most fundamental rule of business economics completely turned on its head. You are literally subsidizing your customers' consumption. And here's the absolute fatal flaw in that setup. The more you sell, the faster you lose. You know, in a normal software business, building the initial product is super expensive, but making a copy for a new user costs practically nothing. So you want as many users as humanly possible. But in this scenario, high volume isn't a victory. It's a total disaster because every new customer, every new chat, every new prompt you type in just drains their resources even faster. You can't make it up on volume if the unit economics are negative. You're just digging the hole faster. Moving on to Section 2, counting the billions and looking at the real-world numbers. When we visualize the actual balance sheet, the sheer scale of the problem becomes incredibly clear. Check out the revenue. They're bringing in a highly impressive $13.1 billion. I mean, most companies would absolutely kill for that kind of top-line number. But then, look at the costs. They are getting crushed under a towering $34 billion. The gap between those two numbers isn't just some minor inefficiency. It's a multi-billion-dollar chasm. It's the banana analogy we just talked about, but playing out on a massive macroeconomic scale. Let's dive into Section 3, the AI cost paradox, and explore exactly why scaling fails here. So this brings us right to the core of our explainer. The AI cost paradox is a financial phenomenon where scaling up your user base and cutting prices to compete actually makes the financial hole much, much deeper due to massive computing costs. This isn't just a bump in the road, guys. It's a terrifying loop. Attempting to grow the way traditional tech companies grow actually accelerates your financial bleeding. You aren't achieving economies of scale. You're achieving diseconomies of scale. You can actually see this paradox in action right here. First, the company pushes hard to scale the user base, right? Getting everyone hooked on the platform. Then, step 2, to keep those users from jumping ship to rivals, they have to cut prices or offer big free tiers just to stay competitive. Step 3, all those millions of users typing in prompts trigger absolutely astronomical compute costs on the back end, which leads inevitably to step 4, deepening that financial hole. They scale up, cut prices, compute costs skyrocket, and their margins just plunge further into the red. It's literally a treadmill that speeds up the more exhausted you get. Now for Section 4, surviving the AI bubble and what the future outlook holds.
Right now, this entire industry is walking a super precarious tightrope. Their massive billion-dollar valuation isn't based on what they're earning today. No way, it completely relies on the promise of future profitability. But right now, computing costs are continuing to vastly outpace revenue. We're all learning the hard way that traditional tech scaling rules simply do not apply to generative AI. Because of this massive disconnect between what things actually cost and what they earn, the risk of a bursting AI bubble is very, very real. They're trying to balance sky-high valuations against massive expenses, but with a completely unproven path to actual profitability.
Ultimately, when you look at that $34 billion in costs versus the $13.1 billion in revenue, you realize that survival isn't guaranteed just because you have the coolest, most famous product on the market. The math forces a harsh reckoning. They are burning cash at a historic rate just to keep the servers running, meaning that the current model absolutely cannot exist indefinitely without a major, fundamental shift in either their cost structure or how they generate revenue. So the big question is, can they reach sustainability before the cash just runs out?
Will the tech eventually become remarkably cheaper to run? Or will they figure out a way to charge vastly more before investors stop handing out bananas to keep the coconut stand open? It's totally a race against time. If you want to keep tracking the real numbers behind this AI bubble and see exactly how this paradox plays out, make sure to subscribe to Financial Bullshittery right now. Thanks so much for joining me for this explainer.